Couple of things, of course, today, kind of kicking off the day. Futures are pointing a little bit higher on the markets as the three-day meeting between the Trump administration and the President Xi administration with China has concluded. Now, both countries are going to make a statement here on Thursday about what they came to. Here, let me tell you what you need to be looking for in the statement. Both countries, the U.S. and China, have been under a lot of economic pressure ever since this whole trade war began. The trade war, as we talked about back in January of last year, we were writing about this. We were talking about it on the radio show back then. Tariffs and trade wars are horrible things for U.S. corporations because 40% of corporate profits, as we've said before, comes from all around the world. So when you start attacking profitability through trade, through higher taxes and higher tariffs, it's going to impact profitability, and the people that are most impacted by tariffs are consumers. So not surprisingly, since this whole thing started, we've seen corporations come out, weaker earnings expectations, concerns about the tariffs in their earnings reports, and we're about to go into earnings season here starting next week anyway, so you're going to start hearing a lot more about this. But also the consumer. We've seen a slowdown, a contraction in consumption, and that's because of what's happening with tariffs and higher interest rates, both. So this whole thing was promulgated, in 2018, late 17, early 18. What you're looking for in this deal is that this is really going to be a statement by both countries that will be laid off as a successful trade agreement. But at the end of the day, when you look at the details, it's basically going to be a resolution to just stop fighting. And that is what both countries need at this point. China's been under a lot of pressure economically. Their economic growth, and again, you really can't believe their economic growth numbers. They come out, they say they're growing at 6%. The reality is that China is probably growing somewhere around 2%. And the U.S. is growing somewhere around 2.5% right now. If we take out the inventory build that was in the third quarter GDP report, and again, why do we have this big big inventory build in the report? Well, that was because all the corporations were pre-stocking on supplies to get ahead of the tariffs. So we had this big buildup in inventories. Strip out that inventory build in the third quarter GDP. GDP grew at 1% in the third quarter. So that's what you really need to know. So what this agreement will show, and again, this is going to be laid off as a successful trade agreement. We got what we wanted. This is great. We're going to move forward. That's going to take pressure off the markets, and we'll talk about the impact of that in a second. But the reality is that most likely there's not going to be anything real substantive to any deal that comes out. And this is going to be an ongoing issue that's going to be heading down the road. Of course, they'll say this is the structure of the agreement. We're going to deal with this more down the road. The hope here is going to be to simply pull the pressure off the markets, get markets back to operating a little bit more efficiently, and take this pressure of this tariff and trade war out of the headlines. It's not been good for the markets. It's not been good for the economy. And of course, that's weighing on both business confidence. We saw yesterday the small business sentiment survey came out. That was the weakest level in 14 months for small businesses around the country. We're already seeing a lot of impact in corporate earnings. Apple, of course, recently impacted most by what happens in China. Really interesting earnings report there. Likely we'll see more of that, but take a look at Federal Express. Federal Express had a horrible outlook going forward into the next year, in particular this year, 2019, because of the global slowdown. Now, the global slowdown is occurring also from simply the fact we've had an economic expansion that's been running about 10 years, so we're very late in this economic cycle. So it's very likely we're going to see a pullback here, but watch this trade agreement over the next couple of days. It is going to be something to try to get this out of the mainstream headline. And again, so if you're watching our live stream right now, if you go to LanceRobertsShow.com or RealInvestmentAdvice.com, either way, you can watch our live stream and see the charts that we're talking about. But here's the S&P just since the Christmas Eve. On Christmas Eve, we plumbed this low, and we talked about then that we'd very likely get a rally, and we've had a very nice rally here over the last 8-9 days. Now, this morning, futures are pointing a little bit higher, but note here that simply all we're doing is just retracing back to where we were in February of 2018, a year ago. We're just simply getting back to that level of resistance. So again, the markets had a very nice reaction to this extremely oversold condition. And of course, it's been clinging on to headlines here the last couple of days about trade wars and tariffs and these type of issues. Hopefully that the market's trying to get back up here. But again, a lot of resistance here for the markets. And again, the real risk here is that we're going to run into a lot of resistance. We've got a lot of negative trends that are currently going on in the markets, downward pressure on prices, but earnings are going to be the key issue. In the course of the next few weeks, in the rest of January, February, and into March, we're going to get a lot of earnings reports. We're going to kick off in earnest next week with earnings reports. Watch what these companies are saying about three things. One, the impact of higher rates. We had rates going up from the Federal Reserve, overnight lending, borrowing costs, et cetera. So that's going to be an important issue to watch for the banks. There's the yield curve, which is the difference between the short-term interest rates and long-term interest rates. Remember that banks in particular, they borrow short and they lend long. So they borrow from the Fed at one rate and then they lend out to you at a higher rate, and that spread is where they make their money. Well, that yield, that difference between those two rates have collapsed markedly, and that suggests that we're starting to see much less profitability in both the financial sector and also less incentive for businesses to go out and borrow because the return on that investment has been shrunk to a great degree. So watch earnings here over the next few weeks. It's going to be very important as we go forward because it's going to tell us a lot about not just what's happening with the markets, but also potentially what the economy is going to look like. There's a real risk that sometime later in 2019 that we're going to be looking at a more recessionary environment in the economy. So again, that's going to put downward pressure on both stock prices and markets, but also we're going to be talking about weaker jobs reports, those type of things. So we want to make sure we've got a handle on that and be ahead of the curve. Take a quick break. We're going to come back. More of the Lance Roberts Show. I've got lots of stuff to get into this morning. Feel free to give us a call as well, 281-558-5738. If you want to join the show, ask questions, happy to help you out. Be right back on the Lance Roberts Show. Give our website, realinvestmentadvice.com or thelancerobertsshow.com. Get our podcast as well as our latest reports and updates right there at the website, realinvestmentadvice.com. We'll be right back.
Want a longer talk with Lance about your money? Request a personal one-on-one at realinvestmentadvice.com.